Welcome to the Deep Dive, your shortcut to understanding the critical developments shaping the market right now.
Today, we're digging into the TrueBridge Q2 2025 earnings call.
Oh.
And look, this one is, well, it's a head scratcher.
Yeah, how so?
Because you've got this immediate, really stark contradiction. Management, they delivered some undeniable financial discipline, clear progress on costs.
Okay, sounds good so far.
But the market, it just slammed them. A brutal double-digit sell-off. We saw the stock drop, nearly 11% pre-market right after the call?
Wow. Okay, yeah, that's a severe mismatch. So our mission here is to unpack that. Why the punishment?
Exactly. Are investors ignoring a solid turnaround story? Or, is management maybe papering over some deeper cracks?
Let's figure it out. We should probably start with the headline numbers, just lay out the basics.
Good idea. It really was a tale of two reports, like you often see. Perfectly highlights this conflict between, profitability and growth.
So the good news first.
Yeah. The bottom line was massive beat. Non-GAAP EPS, earnings per share, came in at 54 cents.
54 cents. And consensus was?
Way lower. Estimates were clustering around $26.29. So, they just blew that away. Management's focus on cutting costs clearly worked. Undeniable success there.
Okay, huge beat on EPS. But you mentioned a conflict, so the other side must be the top line.
That's where investors saw red, yeah. Revenue landed at $85.7 million. Consensus was looking for $87.1 million.
So a miss, but not a huge one in dollar terms.
Not huge, but a miss. And that translated to just 1.2% year-over-year growth, or basically flat, like 1%, if you normalize for their older-centric product that's sunsetting.
Right. Flat growth is tough to swallow, even with the EPS beat.
Definitely. But you can't ignore the quality of the earnings they did generate. Adjusted EBITDA was $13.7 million. That gave them a 16% margin.
And how does that compare?
That's up, a 30 basis point margin expansion year over year. So they're becoming more profitable in the business they do have.
Okay, so let's recap this picture. Massive EPS beat, driven by cost control, solid margin expansion. But the market just hammers the stock because of a, frankly, modest revenue miss. And what came next? The lowered guidance.
Exactly. The immediate signal was loud and clear. We don't care about your profits right now if growth is hitting a wall.
But maybe that's too simplistic. If we dig a bit deeper, is the underlying financial health actually improving?
I think that's the case management was trying to make, yeah. Let's look at the sales pipeline and the balance sheet discipline. That gives context for their confidence.
Okay, bookings.
Bookings, specifically total contract value, TCV, were a bright spot. $25.6 million. That's up 10% year over year.
10% up. Decent.
And maybe even better. Annual contract value, ACV bookings, they were up 13% just from the previous quarter. $19.6 million. These look like high-quality wins.
And the revenue mix, still mostly recurring.
Oh, yeah, very high. 95% recurring revenue. That gives them a really reliable base,
Super important. And beyond bookings, what about that balance sheet cleanup they promised?
They really delivered there. This was a key part of their story, financial stabilization. Look at the cash metrics.
Go on.
Year-to-date, free cash flow was $5.5 million. That's $3.4 million better than the same period last year. Real improvement.
And collections.
Also better. Days sales outstanding. How long it takes to get paid improved by 4 days year over year, getting cash in the door faster.
Okay, so cash flow up, collections faster. That should mean less debt, right?
Exactly. It all culminated in a much healthier balance sheet. Net leverage dropped significantly. It's down to 2.4x now from 3.9x just a year ago.
Yeah, okay. That's a big move.
Yeah.
De-risking the business, which is probably crucial for their hospital clients.
Absolutely. And this discipline, this financial cleanup, it leads us right into the guidance pivot. This is really the heart of the market's disappointment.
Right. They updated the full year 2025 guidance.
They did. And management framed it as a deliberate, acknowledged trade-off. They lowered the top end of the full year revenue forecast. Brought it down to $350 million.
From $360 million before?
Correct. From a $360 million ceiling. And that, right there, is the pain point the market absolutely jumped on.
But you said trade-off. What was the other side of that?
The counterbalance was they explicitly raised the full-year adjusted EBITDA range, lifted it to $62 to $67 million.
Up from?
Up from $60 to $66 million previously.
Right.
So the midpoint reflects a solid 18.5% margin for the full year.
And they gave an exit rate target too, right?
Yeah. Confidence in exiting 2025 at roughly a 20% EBITDA margin. So basically they're saying, look, we're intentionally sacrificing a bit of near-term growth that $10 million at the top end.
For better margin quality and resilience.
Precisely. Which, raises a big question for you, the listener. Can they actually pull that off? Can you trade growth for margin today without hurting your competitive position long term?
And the revenue adjustment wasn't just pulled out of thin air, right? They cited specific reasons.
2 specific execution challenges, yeah. The first one was slightly elevated client attrition in the CBO side of the business.
CBO is customized billing office, part of their financial health unit.
That's right. And we need to be clear, CBO is crucial. It's the back-end stuff, complex billing, collections, account follow-up, really important for hospitals.
So if that unit sees higher churn, it signals maybe a quality control issue or staffing, the very things hospitals outsource to avoid dealing with themselves.
Exactly. It's a bad look. Management admitted it's a remediation project. They set up this proxy group of 60 CBO clients up for renewal to track progress.
How's that going?
Year to date, they've signed 21 out of 26 that came up. But, and this is key, they were candid. They said stabilization is expected in the second half of this year, 2025. But the significant improvement, the real fix tied to operational changes, that isn't targeted until 2026.
Okay, 2026. That timeline is crucial. The market hears that and thinks that's a long time to fix a core problem.
Understandably skeptical. But there's a second factor they cited for the revenue adjustment. And this one is, well, what management calls the growing pains of success.
Growing pains. How does success hurt revenue now?
It's about the type of deals they're winning. They're successfully shifting to larger, more integrated deals, which is great for the future, right? Better quality revenue.
Yeah.
But these big deals, the ones over $1 million in recurring revenue, they take longer to implement, about 6 months to go live.
Compared to what for smaller deals?
Just 1 to 2 months for the smaller stuff they used to focus on.
Ah, okay. So the big good deals signed recently.
Exactly. The really meaningful deals signed in Q1 and Q2, including a large expansion deal they specifically highlighted on the call. They're basically sitting there, booked, but won't contribute a single dollar of revenue until 2026.
So it's not lost revenue, it's just delayed revenue recognition, pushed out.
That's the argument. You're asking investors essentially to accept 6 months or more of, let's say, slower reported growth today for what should be superior, higher quality revenue next year.
And the market hates waiting, especially with that CBO issue lurking.
Right. So if we take management's story at face value, the core issue boils down to execution velocity and fixing that CBO problem.
So what are they actually doing right now? What levers are they pulling to make sure 2026 sees that revenue reacceleration and CBO gets fixed?
Well, the margin gains weren't accidental. That was hard work, they said. Labor cost optimization, reviewing vendor deals, and importantly, that global offshoring initiative.
The offshoring ties into the CBO fix, right?
Directly. To standardize quality, improve retention, hitting that CBO problem head on, they're establishing a physical, dedicated presence in India.
A TrueBridge facility, not just outsourcing.
Exactly. A physical center targeted to open sometime in 2026. The idea is better training, better quality control, more accountability.
That sounds like a structural fix. It costs money today, the build-out costs. But it's meant to solve the underlying issue that likely caused the revenue guidance cut in the first place.
That seems to be the plan. It mitigates that perception, that offshoring automatically means lower quality. They're trying to own the process.
Anything else on the foundational side?
Yeah. They also appointed KPMG as their new independent auditor.
Switching auditors. Why is that significant?
Well, moving to a globally recognized Big Four firm like KPMG, it sends a signal. It suggests a stronger commitment to financial controls, credibility. It kind of supports the whole narrative of de-risking the business, making it more robust.
Okay, makes sense. What about innovation? Are they keeping up with tech and regulations?
Seems like it. They made a point of mentioning they signed the CMS interoperability pledge at the White House.
So aligning with data sharing standards, important for healthcare IT.
Crucial, and maybe more tangible for their actual hospital clients. They're integrating Microsoft Dragon Copilot into their EHR solution.
Dragon Copilot, the AI transcription tool.
Exactly. Integrating it into the electronic health record system. They said it should be available later this fall.
That could be huge for their target market, right? Rural and community hospitals.
Massive potential. Streamlining clinical documentation, cutting down paperwork that helps reduce physician burnout, could improve billing accuracy. It lets doctors focus more on patients. That's a real differentiator against competitors who might not have that kind of integration.
Okay, interesting. So zooming out a bit, what about the macro environment? How's that playing into things?
Well, hospitals generally are still under intense margin pressure. That's not new. But paradoxically, that pressure often drives demand for services like TrueBridge, offers revenue cycle outsourcing. Hospitals need help optimizing their finances.
Makes sense. Did they mention any specific regulations impacting things?
Yeah, they addressed the OB3 legislation. They called it the One Big Beautiful Bill. Apparently, this created a lot of uncertainty in the first half of the year. Hospitals paused some planning, especially around Medicaid eligibility changes.
So OB3 caused a pause, but is the uncertainty over now?
That's the point. The law is now certain, so hospitals can finally plan again. Management admitted this might actually create a bit of a sales headwind in the second half of this year as hospitals focus internally on adapting.
Okay, a short-term headwind.
But they argue it creates a massive long-term opportunity for TrueBridge. Why? Because now they can actively help clients navigate all those complex Medicaid changes.
Turn the regulation into a service offering.
Exactly. And crucially, help them potentially tap into that $50 billion rural healthcare fund that was part of the act. It becomes a sales driver eventually.
Okay, so let's try and tie this all together. The narrative seems to be 2024 was a reset, 2025 is the rebuild year. Focus on margin, cash flow, fixing operations like CBO with the India Center.
All designed to set the stage for 2026. That's when they expect revenue to reaccelerate as CBO stabilizes and those bigger delayed deals finally start contributing.
A 2-year plan, basically, which brings us back to the market's reaction today. Very short-term focus.
Very, which leads us nicely into.
This is the not financial advice segment. Okay, so given this huge disconnect, the market focusing intensely on the revenue miss, that near 11% sell-off.
Right.
It feels like the collective view is just completely ignoring the raised FY25 EBITDA guidance and ignoring that 2026 revenue pipeline being built by those delayed larger deals.
It really does seem that way. The market's treating the CBO retention issue like it's, an existential flaw, a sign the business is fundamentally broken.
When management is saying, no, we have concrete plans, we've got new leadership there, we're building the India Center, we signaled credibility with KPMG.
And we expect this to be largely stabilized by 2026. But the stock is pricing in something much worse, almost like those fixes won't work or won't happen.
Okay, so based on that interpretation of the call, here's a potential trade idea. Again, not financial advice.
Go for it.
Pitching a long position in TrueBridge equity, paired with a short position in a, let's say, pure play RCM outsourcing competitor. Someone who doesn't have TrueBridge's integrated EHR and patient care software stack.
Interesting pair trade. What's the rationale?
It's pretty simple, actually. The 2025 margin strength that raised EBITDA guidance provides a kind of floor for TrueBridge's stock. They are fundamentally a better run, more profitable company today than they were a year ago, based on these results.
So the cost control acts as a buffer against the short-term revenue anxiety.
Exactly. And then the potential kicker is 2026. If management executes and those high-quality Q1, Q2 large deals actually go live like they're supposed to.
That revenue reacceleration acts like that coiled spring we mentioned, triggered by the go-lives.
Right. So the trade leverages TrueBridge's integrated platform, that EHR patient care moat, and their demonstrative margin control against a competitor who might be more exposed, who doesn't have that software advantage, and might be facing similar industry pressures without the same levers to pull.
It's a bet on execution, and that the market is mispricing the timeline. Okay, let's recap the whole thing then.
TrueBridge delivered a really strong profitability story this quarter. Clear cost discipline. You see it in the huge EPS beat, the raised EBITDA guidance.
But investors punished the stock severely. Why? Near-term top-line worries. Those CBO client retention issues, plus the delayed revenue from the bigger, better deals they're signing.
So the big question left for you, the listener, the long-term learner, is this. Is all this cost control, the strategic moves like the CMS pledge and the Copilot integration, are these genuine signs of a fundamental turnaround?
Or, is management just playing a smart 2-year game, fixing things behind the scenes that the impatient market is just completely mispricing right now?
Look past the immediate noise, focus on that timeline. Is the 2026 reacceleration credible?
That's the multi-million-dollar question.
Thanks for diving in with us on the deep dive. We'll catch you next time.